All right, good morning, everybody. Sorry, I am not able to be there. Would love to had a closing pop up, which is great, but would love to have been there in person to have this discussion. Thank the Lord for technology that I am so good at. With the help of Scott here today, I think we're going to be able to kind of do a discussion on taxes, tax prep, of ways to avoid paying taxes, and then also have our accountant here in person, and hopefully I'll be able to sneak in towards the end of this training. But welcome everybody. Hope you're all having a good day. Today we're going to talk about taxes, of that, tax write-offs, investments, preparing and paying for taxes, as well as an S corporation. So I'm going to jump right into it, and we will have Q&A after this, and hopefully Becky, our accountant, can answer a couple questions, and then I will be able to help out as well. So you may want a note card to take some notes, and again, you can reference this video at any time. We will upload it to the agent portal. So first of all, taxes. You get paid a commission. Taxes are not pulled out of that commission for you. That is done by you, or if you run your stuff through a payroll system, or if you just pay estimated taxes. So let's jump right into preparing for taxes. When you get a commission check, we will use $10,000 as a figure for a commission check because it's easy math. So preparing for taxes, you will want to set aside 20 to 30% for taxes that you will pay either come every quarter, or for your estimates, or at the end of the year when taxes are due, however you decide to do that. So 20 to 30% set aside for your taxes, so you don't get surprised come tax season. A way to avoid a large payment come tax time is to pay those taxes through payroll. So you run your commission check through payroll, and you pay the taxes as a part of that. That's one option. Another option is you can set that percentage aside, put it in a separate bank account, and you can pay estimated taxes, which are paid every quarter, which will ultimately, both of those options are going to ultimately allow you to avoid any fees if you wait till the end. And I think Becky can probably give you more as to what those fees may be, as we kind of discuss that Q&A. So preparing for taxes, making sure you're prepped and you're not just spending the commission dollars as you earn them, because you will be required to pay tax on those funds. So that is our first bullet: preparing for taxes. That is a good way to do that. The way that you get out of paying more taxes, that's where we're going to go. We have write-offs, investments, and an S corporation. Those are the few things that I know, that I do, that I've worked with Becky to help in shielding, I guess, in a way, some of those taxes. So first off, write-offs. Write-offs are very important because they will reduce your gross income down to what's called your net income, which allows you to be taxed on a little bit less money. So for instance, one thing that we do a lot of, that you all know, is we drive. We drive a lot. Mileage or miles allow you a write-off. I believe it's 55 or 56 cents per mile, and that changes year in and year out. But if you track your mileage, it will allow you to write that off at the end of the year. So one good application on my phone that I use is called Mile IQ. Mile IQ. We'll try and put some pop-ups here in the screen if we can figure that out. I mean, you know me and my tech savviness. So Mile IQ, we'll try and get that app, the picture of that app up so you can see it. It is relatively inexpensive. I think it's about $60 for the year if you pay it yearly, something like that. That write-off alone, I mean, if you drive 10,000 miles for business and it's 55 cents a mile, $5,500 straight off of your top line, your gross income, to reduce that down to your taxable income. Another thing that I like to do for easy tracking is I have created a business credit card for anything real estate related. My signs, if I do meals, if I take someone to coffee, any marketing that I do, I put that on a business credit card. Business credit card can be in your name, or I'll touch on it later, in your S corporation's name, so that at the end of the year you can go and easily in one spot you can say, okay, I have spent X amount of dollars. Again, this is a write-off. Those dollars spent allow you to reduce your gross income to make your net taxable income a little lower, so you're paying a little less tax. So that is a easy way to track that. Otherwise, if you put it on your personal card, you kind of have to go through and sift through and find each one of those expenses and those write-offs, and that is taxing, as we all have credit cards and trying to find what was paid for what and to whom, and it can get a little confusing. So I've found that having my own business credit card seems to work better for me. Hopefully that is the same case for you. Another great thing about a business credit card is I'm a points guy, so having the ability to create more points on some credit cards to help for flights or travel, rental cars, hotel stays, etc. And some of those I think even are cash back. So those would be some great benefits of having a credit card, as well as just that expense tracking. So those are a few. There are a lot of things that you can write off. Your cell phone, your home office, if you use portions of your house for your home, there's some formulas there that we would work with our accountants to draft up. Utilities, I mean, you name it. If you spend money on it that helps you in your business, that is a write-off, and that does help the bottom line. One thing with write-offs that you'll want to be careful of, writing off and saving money on your taxes is a great thing, but the potential gotcha there is your financeability. If you decide that you want to buy a house, let's say, and you've reduced your income down to zero, well, now you'd show to a bank that you don't make money. So that's one area that we'll just want to keep an eye on, as you want to make sure that you're, it's kind of riding this wave. You want that fine line of where you want your income to be, so yes, you will pay some tax, but, still allows you to finance a house or a car or whatever if that's the choice that you make. So that is the section on write-offs. So we've prepared now for our taxes. Now we are figuring out the write-offs on what we can and can't write off, how we write it off, and where do we end up with our net income from gross. We're writing those down, writing those off, so that we don't have to pay as much in tax. The whole goal here is how do we keep the most money in our pocket, but also, still needing to do our part. And there is tax involved, and we've got to pay our part, making sure that we're doing it the right way. A couple of other options that I've seen good success with are investments. Any investments that you have allow you to potentially reduce some of your gross income. I would suggest, if you don't have one, getting a financial advisor. Not only because it's good to have a financial advisor, but from a referral perspective, look at Scott, for instance. He has a financial advisor that is just blowing him up with leads. I have one as well. I've gotten some leads from JT as well. Financial advisors are great because they want to connect their people with good people. So setting yourself up with a good financial advisor would be important for you and potentially for your business. So that's one thing I would suggest. If you want a referral for that and you want to work with people that we know, talk to us. JT Ham at Edward Jones. Scott has a guy. His name's escaped me at the moment, but reach out to him and ask him. But those would be some good steps for financial planning and your future planning. So within those investments, I would look at a few things. I would look at what's called a solo 401k and a Roth IRA. Both those are different. I'm no financial planner by any means, but from a reduction of income perspective, the Roth does not allow you to reduce your commission rate, your gross income, but the solo 401k does. So the Roth is after tax dollars, grows tax free. The solo 401k is pre-tax dollars, and you can pull it out with penalties. Again, talk to your financial advisor about this, but the idea behind that would be waiting till you're at retirement age to start pulling from that information or from that bank account, that solo 401k. So with a solo 401k comes the opportunity of adding your spouse to and matching from your S corporation, which we're getting to. So the solo 401k will allow you to directly reduce the amount in which you invest into it from your gross commission that is earned. So let's say you've earned $100,000 and you decide that you want to put $10,000 into this solo 401k. Well, you just made your $100,000 of gross or taxable income netted that down to $90,000. So again, you can kind of do the math. You reduced it by $10,000. If you're in a 20% tax bracket, well, you just saved yourself $2,000 in tax payments. So there's some benefits, large benefits there. We'll try to throw some of these math equations up on the screen here to help just put that out there so you can get an idea in print rather than me just speaking it, and then that'll help you to translate that into what you decide ultimately to do with your tax investments. So the other one, Roth, there's a $55 or a $6,000 limit, $5,500 or a $6,000 limit, I think is what the limit is for someone who is under the age of 55 or 60, and that does go up the older that you get. That money is post-taxed dollars that grows tax-free. You can put in that $6,000 per year. You can do that for yourself. You can do that for you and a spouse if you have one, which does starts to add up, year over year if you continue to do that, and the investments grow tax-free. If you start that when you're 25 or 30 and you do that for 20 years, that's gonna turn out to be a pretty good number that you would like. So I would say if you can't do the 6,000, by all means do something. Just start with 1,000. Start with $500. Or say, hey, every check that I make, I'm going to put this amount of percentage into my investments. If that's the solo 401k or if that's the Roth, both great vehicles. The solo 401k does have limits as well. I want to say it's really high, $40,000 maybe for an individual, and then your spouse I think has like maybe an $18,000 limit, and then your company meaning your S corporation can match match that amount. You'll have to double check me or talk to a financial advisor on those exact figures, but it's in that ballpark. It's high numbers. It's good a vehicle to reduce income, but ultimately, it's going to set you up well for your retirement when that time comes. So we have now covered write-offs, investments, and preparing for taxes. The big one, the main one that I want to talk to you guys about today, that I feel is potentially the best bang for your buck, if you will. This is the one that we started, Becky and I started with, and then we grew from there. Ultimately, it comes down to the fact that taxes, much like real estate, it's creative. You look at the vehicles that make the most sense, and you try to play this game, of what makes the most sense for you. This one makes a lot of sense for a lot of agents. The S corporation or an LLC, you can set up either, and they both have their benefits. I personally have an S corporation that I pay. I would look at the S corporation as a pass-through account in a way. So if we played this out, there is let's go back to that $10,000 commission, because that's an easy math number. There's a $10,000 commission that is earned. My S corporation is called J. Bell Mentisel Inc. Rise Real Estate pays J. Bell, and then J. Bell can ultimately pay myself, Jon Bell. That's kind of the sequence of events. You can run that through payroll every time. You can do that in lump sums. There's a couple of different ways to do that. The S corporation, I find, based on the cost of having your S corporations, beneficial if you make in the neighborhood of $40,000 to $45,000 in commissions, gross commissions per year. The reason being is because the savings for the S corporation come from what they call distributions from that S corporation. So there's two things that are going to happen in an S corporation. You're going to pay yourself. So in my scenario, J. Bell Mentisel Inc. is going to pay Jon Bell, and you're going to pay yourself what's called a good and reasonable salary. That number for somebody earning $40,000 to $45,000 in gross commission income is likely going to be about $30,000, maybe $35,000. That good and reasonable salary, the $35,000, is going to be paid like any other salary. It's going to be a W-2. It's going to have taxes pulled out of it. Again, if that's done every check or in a lump sum of that good and reasonable salary, that is up to you. But that salary portion is going to have your taxes pulled out, state, federal, Social Security, I believe. So basically anything like you would be if you were paid a salary from a job that's getting W-2 income. After you pay the salary, you've met that, let's call it $35,000 cap. Every amount that you send from, in my case, J. Bell Mentisel to Jon Bell, you're saving the self-employment tax on. That amount is 15%. So this example we've been talking about is a $10,000 distribution. So you made $45,000 gross commission income. You paid yourself $35,000 in a salary. You have $10,000 left. We're going to try and put that up on the board. I'm going to say it one more time. You have $45,000 in gross commission income. You have $35,000 in your salary, which leaves 45 minus 35, leaves you with $10,000. You distribute that $10,000 from J. Bell Mentisel, in my case, to Jon Bell, and you save on that $10,000, the taxes of self-employment tax is taxed at 15%. So in that scenario, that $10,000 times 15% that you're not paying saved you that tax of $1,500. That is why it is good to have an S corp or an LLC. That and that only begins to add up. So you start to do this, where you go from 45,000 gross commission income to 55 to 65 to $100,000. You get to the point where, and even again, let's just use this for easy math purposes. Let's say you make $135,000 in gross commission income, and you paid yourself the $35,000 for your salary. Well, now you have $100,000 that you're going to distribute over the course of a year, and you're saving 15% on that. Well, now you just saved yourself $15,000. That is huge. That was one of the biggest aha moments I had with Becky when we sat down and started getting creative as to how do we save taxes. That was one of my favorite conversations, as you may imagine. So that was probably 4 or 5 years ago that we found or figured this out, maybe longer now at this point. So you think about this, you do this year over year over year, and now you're saving, tons of money, 15% on any amount that you've earned. That adds up quickly. So having this big creative session with your accountant, I'm a huge proponent of Becky Zulager. She has been a huge success story for me, and I think now Scott and Trent and Maggie use her as well. She's been super instrumental in allowing creativity to flow through tax, and how we can learn and grow together to reduce tax obligations. So back to these S corps, the tax savings comes from your self-employment tax distribution. There are other things that you can do with your S corporation if you decide later you want to own real estate through it. That is an option. More than just paying yourself. So there are a lot of uses for that. In this case, I pretty much strictly use it for just the pass-through account and the distributions, the salary, etc. So that S corp is definitely the way to go. The LLC, that's the version that I believe you can own real estate in. S corp might be different. Hopefully Becky can answer that question. I think that's pretty much it. We're going to pop up some of those math equations here one more time, just if you didn't get those written down. This will be available in our agent portal. I am excited to talk with you guys more about this, and Becky Zulager is here, I believe, and she is going to kind of have some Q&A and is available. She's going to hang out with us for some of the day today, so that you can talk to her if you want to have some one-on-one time and just do some dreaming of your own and what you can figure out with your own taxes. That's totally fine. That is why she's here. Everybody give a round of applause for Becky, and have a good day, and we'll look to talk to you guys soon.